Hey everyone, and welcome back for another deep dive. You ready to do some more economic sleuthing?
Always.
Because let me tell you, the latest data has got us all scratching our heads. Like the economy's trying to pull a fast one on us.
It definitely keeps us on our toes.
You can say that again. So the unemployment rate, it just took this unexpected dip down to 4.1% in September. That's down from 4.3% in July.
Yeah.
And Wall Street, well, they seem to be breathing a sigh of relief after what I can only describe as a collective mini freakout. But should we be celebrating just yet?
Well, I think maybe we should hold off on ordering those celebratory pizzas for now.
Yeah.
You see a drop in the unemployment rate on the surface. It sounds like a good thing, right?
Yeah.
But we got to dig a little deeper here. Think of it like this. We need to be like those economic detectives on TV. It's not enough to just find a clue at a crime scene. We got to figure out what it means. Why is it there? What does it tell us?
Okay, I'm listening. I'm intrigued. Let's put on our detective hats. What's the story behind this surprise drop?
So the number of unemployed people actually did go down
Okay.
by about 330,000 people between July and September. But, and this is a big but, for the total number of people who are either working or actively looking for work, we call the labor force.
Right.
That number actually went up.
So it's not as simple as fewer people being unemployed. It's more like things are shifting around.
It's like someone snuck in an extra chair during a game of musical chairs. And then a bunch more people suddenly decided to play too.
Okay, that's a pretty good analogy. So it's not just about how many people are out of work. It's about how many people are even in the game to begin with.
Exactly. And that changes the whole game, doesn't it?
It really does.
Yeah.
So what else does our economic magnifying glass reveal? What other clues are we seeing?
Well, we take a closer look at the types of unemployment. This is where it gets really interesting.
Mm-hmm.
So, short-term unemployment.
Oh.
The folks who've been out of work for less than 14 weeks.
Right.
That number actually went down.
Okay.
And we think part of that is likely due to just like temporary stuff resolving. Remember that crazy tidal wave we had on the East Coast back in July?
Oh, yeah.
And then on top of that, it was the end of the summer.
Right.
Teachers.
All the teachers are out for the summer.
Exactly. A lot of teachers. Technically, they're considered unemployed during those few weeks in the summer.
It's true. My neighbor is a teacher, and every summer I'm like, so you're off on your free time.
Exactly. So those are just temporary situations, like
Yeah.
those folks went back to work at the end of the summer, or they found new jobs.
Got it.
But here's the catch. Long-term unemployment. Those are the folks who've been jobless for 15 weeks or more. That number actually went up.
Oh, so even though the overall unemployment rate dropped, the news for people facing long-term unemployment isn't so great.
You got it. Unfortunately, yeah. And you see long-term unemployment. That tends to be a much better indicator of the labor market's overall health.
Hmm.
It's less about those like temporary blips like a tidal wave or, summer break, and more about the deeper underlying currents in the economy.
So we shouldn't get too excited about one single month's data.
Exactly. One data point does not a trend make.
Yeah.
It's like looking at just one single piece of a puzzle and thinking, what the whole picture is going to look like.
Right.
We need a lot more pieces to really understand the bigger picture. And one way we can do that is by looking at what's called the ratio of long-term unemployed to total unemployed. Basically, how many of all the unemployed people have been out of work for a long time. And historically, this ratio, it tends to move pretty closely with economic cycles, kind of like they're dancing together.
Interesting.
Right now, that ratio is sitting at 1.6%, which is higher than it was before the pandemic hit.
Okay. So it sounds like we've got this headline number, the unemployment rate, which honestly sounds pretty good when you just say it out loud. But then when we start to dig a little deeper, we're seeing some cracks in the foundation.
Yeah, it's a bit of a mixed bag for sure.
Yeah. Which leads me to my next question. If the unemployment rate alone isn't giving us the full story, then what should we be paying attention to?
The million-dollar question, isn't it?
It really is.
Well, there are a couple of other indicators that we can look at. These are what we call leading indicators, because they can actually give us a little glimpse into what the job market might look like down the road.
Ooh, leading indicators.
Yeah.
I like the sound of that. Tell me more. What kind of sneak peeks are we talking about here?
So one of them is called the quits rate.
The quits rate. That sounds kind of bold.
It is. It's basically just a measure of how many people are voluntarily leaving their jobs each month. They're quitting. They're saying, see?
Wow. Okay, so if the quits rate is high, that means people are feeling pretty confident about their job prospects. They're not afraid to quit their job because they think they can easily find a new one.
You got it. It's like a vote of confidence in the job market.
I like it. Okay, what about the other indicators? What else can give us some insight into what's going on?
So another big one is the hiring rate. Basically, how many new positions companies are filling each month. Are businesses feeling good enough about the economy to expand and hire more people? Or are they tapping the brakes and putting those now hiring signs away?
So the quits rate gives us a sense of how confident workers are feeling, and the hiring rate is more about what businesses are thinking and doing.
Exactly. So by looking at both of them together, we can get a more well-rounded view of the labor market.
So are these indicators flashing green lights right now, or are they more like warning Will Robinson?
Well, so far, neither the quits rate nor the hiring rate are really showing much improvement. They haven't really kept pace with that drop in the unemployment rate that we saw.
So it's like those puzzle pieces from before, they aren't quite fitting together yet.
Exactly. The unemployment rate is telling us one thing, but then these other indicators are hinting at something a little different.
A classic case of mixed economic signals. It's enough to make your head spin.
You can say that again.
And speaking of head-spinning economic news, the Fed just decided to cut interest rates again. So
Yeah.
help me understand this. What's the deal with that? And more importantly, what does it mean for regular people like me?
Ah, yes, the Fed. They do love to keep us all on our toes, don't they?
Yeah.
And you're right. There's been a lot of talk about their recent rate cut. But here's the thing. Contrary to what a lot of people think the Fed cutting rates, it hasn't actually led to easier financial conditions out there in the real world.
Wait, really? But I thought lower interest rates were supposed to be a good thing for people who need to borrow money. Like it's easier to get loans and stuff when rates are lower.
Well, you would think so, wouldn't you? But the economy,
Hmm.
it's a complicated beast. There are all these other factors at play. So let's look at some real-world examples to illustrate what's actually happening, shall we?
Yes, let's.
So first up, let's talk about junk bonds.
Junk bonds. Okay. So are they called that because they're like the scrap metal of the financial world?
Pretty much.
Yeah.
Junk bonds are basically a way for companies that aren't doing so hot financially to borrow money.
So they're a little riskier.
You got it. And the riskier the investment, the higher the potential return.
Hmm.
But also the higher the chance that you could lose your shirt.
Makes sense.
So the yield on a junk bond, that's basically just the interest rate that the borrower has to pay on that loan.
Yep.
And here's the thing. Even though the Fed has been cutting rates, those junk bond yields, they haven't really budged much. Some have even gone up a bit.
So even though the Fed is trying to make borrowing cheaper, it's not actually making a difference for those companies that probably need it the most.
Exactly. It's a head scratcher for sure. And now let's talk about something that hits a little closer to home for a lot of folks out there. Mortgage rates.
Ooh, yeah. Mortgage rates. Everyone's talking about those these days.
Right. And you might be surprised to hear this, but mortgage rates have actually gone up since the Fed started cutting rates.
Hold on, what? Seriously? That doesn't make any sense. I thought lower Fed rates are supposed to mean lower mortgage rates? Isn't that how it works?
It definitely seems counterintuitive.
Oh, I know.
But the thing is, mortgage rates, they're actually tied to something called the 10-year treasury yield. It's a mouthful, I know.
Okay.
Basically, it works like this. When the government needs to borrow money, they issue these things called treasury bonds. You've heard of those, right?
Sure.
And the 10-year treasury bond is a pretty popular one. And its yield. That's basically the interest rate that the government has to pay to borrow money for 10 years.
Got it.
So for a bunch of different reasons.
Yeah.
Those 10-year treasury yields have been rising lately.
Okay.
And because mortgage rates are linked to them, they've been going up too.
So even though the Fed is cutting rates, other things are pushing mortgage rates up.
It's like a game of tug-of-war. And right now, those other factors are winning.
Wow. It really goes to show that things are never as simple as they seem on the surface.
You can say that again.
Okay, so we've got junk bond yields being stubborn. We've got mortgage rates going rogue. What's our third example?
All right. Well, let's talk about the U.S. dollar index. Have you ever heard of that?
Vaguely. It rings a bell.
Think of it like a popularity contest for the U.S. dollar. Basically, it measures how strong the U.S. dollar is compared to other currencies around the world.
Got it.
And guess what? Since the Fed started cutting rates, the U.S. dollar has actually gotten stronger.
Interesting. So what does that mean exactly? Like what happens when the dollar is strong?
Well, they can actually make it more expensive for businesses and investors to borrow money for things like international trade. Yeah, which can actually end up tightening financial conditions even more. It's kind of counterintuitive.
It's like some kind of economic domino effect. The Fed does one thing and it ends up rippling out and causing all sorts of unexpected consequences.
You got it. And that's why it's so important to look beyond just the headlines and try to understand all of the nuances of these economic indicators and what these policy decisions really mean.
It sounds like we need to do some serious economic detective work.
We do.
So to recap, we've got some things that look good on the surface, but then when we dig a little deeper, there are some pretty big red flags popping up. So what's coming up next that might help us make sense of all of this? What other economic clues should we be on the lookout for?
We'll keep an eye out for a couple of important data releases coming out this week. The CPI and PPI. You familiar with those?
I've definitely heard them thrown around. But to be honest, I don't really have a good grasp on what they actually measure.
Right. So the CPI, that's the Consumer Price Index. And then you've got the PPI, which is the Producer Price Index.
Okay.
And basically, they're both tracking inflation, but from different angles.
So like two sides of the same coin.
Exactly. So the CPI, that measures the average change in prices that we pay as consumers for things like groceries, gas, housing, all that good stuff.
Okay. Makes sense. What about the PPI then?
So the PPI, that tracks the average change in prices that domestic producers are receiving for their goods and services.
So if the PPI is going up, that means businesses are paying more to produce their stuff.
Exactly. And you know what that means, right?
Oh. Sounds like those price increases could end up getting passed along to us consumers.
Bingo. Which is why both of these reports are super important to keep an eye on, especially right now with all the talk about inflation and the Fed trying to keep it under control.
So how does the Fed's recent decision to cut interest rates play into all of this?
Well, these upcoming reports, the CPI and PPI, they're going to give us some insight into whether the Fed's strategy is actually working or if they're just, spitting into the wind.
Spitting into the wind. I like that. So what's the general consensus right now? Should we be dusting off our old disco outfits and bracing ourselves for a repeat of 1970s style inflation?
I think we can leave the bell bottoms in the closet for now. The current expectation is that both CPI and PPI, they're probably only going to show like modest increases. Nothing too crazy. But, and this is a big but, it's not just about the number itself. It's about the why behind the number.
Okay, break that down for me. What exactly do you mean by that?
So let's say the CPI, for example, comes in higher than expected. We need to figure out why. Is it because something like housing costs have gone through the roof?
Right.
Which, that can happen sometimes. Housing can be really unpredictable.
Right.
Or are we seeing broader, more systemic price increases across the board? Like for a whole bunch of different goods and services. That's a really important distinction to make.
Okay, so it's like when you see a single shoe lying in the middle of the road, is it just some random weird thing? Or is it a clue that something much more interesting happened?
Exactly. And just like a good detective, we got to analyze all the evidence before we can draw any conclusions.
I'm ready to dust for fingerprints. Okay, so we've got the CPI and PPI coming up. What else should we be paying attention to in the coming weeks?
Earnings season is right around the corner. And that means we're going to get a fresh batch of earnings reports from companies across all different sectors of the economy.
Ooh, yes. Earnings reports, they're always a wild ride.
They are. And they can tell us a lot about how different parts of the economy are actually performing out there in the real world.
Yeah.
Beyond just the headlines and the data.
So which sectors should we be paying extra close attention to?
Well, the banking sector. That's always a good one to watch because they're like a canary in the coal mine for the overall economy.
Because when banks are doing well, it usually means that businesses and consumers are feeling good too.
Exactly. Their earnings reports can give us some valuable clues about consumer behavior, like are people taking out loans? Are they spending or saving? All that factors into how the economy's doing.
Right, because when people feel good about the economy, they're more likely to borrow money. Maybe buy a house, take out loans to start new businesses, all that fun stuff.
Exactly. But then when people get nervous about the economy, they tend to tighten their purse strings.
Makes sense. So basically, we want to see if banks are reporting strong loan growth, because that's a sign that people are feeling confident about the future.
You got it. Okay, and then another sector that I'm keeping a close eye on is the travel industry. They've been struggling a bit lately.
Yeah, I've heard that. My friend's a travel agent, and she's been complaining nonstop about how slow business has been. Everyone's freaking out about the price of plane tickets these days.
No kidding. Have you seen the price of jet fuel lately?
Don't even get me started.
But that's actually exactly why this sector is so interesting to watch right now. Because travel, it's often seen as a discretionary expense.
Meaning?
It's one of the first things that people cut back on when they start to get nervous about the economy. It's a lot easier to postpone that trip to Hawaii than it is to skip paying your rent or your grocery bill.
True, very true. So if airlines and hotels and all those travel-related companies are reporting strong earnings, that's a good sign that consumers are still feeling pretty optimistic. But if their earnings are down, that's when we should start to worry.
You got it. It's all connected.
Wow, this is fascinating. It's like learning a whole new language.
It is. But once you understand the basics, it's actually pretty easy to follow along.
So you're telling me I can understand this stuff.
Absolutely.
This is a huge moment for me.
I'm proud of you.
So I have a question about something you mentioned earlier. You said that these earnings reports can give us a glimpse into what's really happening in the economy, beyond just the headlines and the data. So I'm curious, how much faith should we actually be putting in the official data? I mean, remember a few weeks ago when everyone was convinced that the Fed had this like super secret depressing economic forecast?
Oh, yeah. Like they had some insider information that the rest of us weren't privy to.
Exactly. Social media was blowing up. Everyone was freaking out about it. But
We
then,
got the September jobs report, and unemployment had actually gone down.
it was like the economy did a complete 180. So how are we supposed to make sense of anything when even the experts seem to get it wrong sometimes?
It's a great question.
Uh,
Honestly,
yeah.
there's no easy answer. But I think one of the most important skills you can develop is learning how to think critically about the economic information that's coming at you from all sides these days.
Okay, I like that. So it's less about having a crystal ball and more about being able to like sift through all the economic tea leaves and form our own conclusions.
Exactly. No one, not even the Fed, has all the answers when it comes to the economy.
So how do we actually do that? How do we develop those critical thinking muscles when it comes to something as complex as, the global economy? Where do we even begin?
Well, it starts with understanding that not all economic information is created equal.
Okay.
You got your raw data, things like the unemployment rate, inflation numbers, GDP growth, the basic stuff.
The raw ingredients of our economic soup.
Exactly. But then on top of that, you've got analysis, which is where people take that raw data and they try to, connect the dots, make sense of it all, tell a story.
And that's where things get a little messy.
A little messy is an understatement. I mean,
Okay.
everyone and their brother has an opinion on the economy these days. Am I right?
Don't even get me started. I swear my Uber driver this morning had a whole conspiracy theory about inflation.
Right. Everyone's an armchair economist these days, and that's fine. Everyone's entitled to their own opinion. But it's important to remember that those opinions, even the ones from like really smart economists with fancy degrees, they're often influenced by their own personal biases and beliefs.
So it's like everyone's working off the same recipe, but they're all adding their own secret ingredient.
Exactly. You got to ask yourself, could this analysis be influenced by anything other than just the pure objective data?
Okay, that's a really good point. So how do we spot those potential biases? Are there any red flags we should be on the lookout for?
Absolutely. One thing to watch out for is overly strong language or predictions.
Like the economy is doomed, everyone run for the hills.
Exactly. Anyone who speaks in absolutes about the economy should set off alarm bells, especially if they're trying to sell you something.
Because no one can predict the future with 100% certainty.
Exactly. And on that note, be wary of anyone who presents themselves as some kind of economic guru with all the answers.
Okay.
Good economic analysis. It's about acknowledging uncertainty. It's about exploring different possibilities. It's about being really transparent about what we know and what we don't know.
So it's more about asking the right questions than having all the answers.
You got it. And don't be afraid to challenge assumptions either, both your own and the ones that are presented to you by experts.
Even if it's coming from like a well-respected economist or a big-name financial publication.
Especially then. Just because someone has a PhD after their name or they work for the Wall Street Journal doesn't mean they're always right.
It's like my grandma always used to say, just because someone tells you it's raining doesn't mean you shouldn't go check for yourself.
Your grandma sounds like a wise woman.
She really was. So we've talked about the importance of thinking critically about economic information, but what about specific things to look out for when we're trying to make sense of the economy? Like you mentioned, those earnings reports that are coming out soon. What should we be paying attention to specifically when we're looking at those?
Well, when it comes to bank earnings, one really important thing to focus on is loan growth.
Loan growth. Okay.
Yeah. Basically, we want to see if banks are lending more money or less.
Yeah.
Because that can tell us a lot about how confident businesses and consumers are feeling.
So if loan growth is strong, that's a good sign.
Exactly. It means businesses are investing in growth and consumers are feeling good enough about the future to take on more debt. But if loan growth starts to slow down, that could be a sign that people are getting a little nervous about the economy.
Makes sense. What else should we be looking at?
Credit quality is another big one. Are more borrowers falling behind on their loans? That could be an early warning sign of trouble brewing.
So it's like we're looking for those subtle shifts and patterns that may give us a heads up about what's coming down the road. And what about the travel industry? You mentioned that they've been going through a bit of a rough patch. What should we be looking for in their earnings reports?
Right. So remember how we were talking about discretionary spending?
Yeah, like the things we buy when we have a little extra cash but can easily cut back on when times are tough.
Exactly. Well, travel is a perfect example of that. When the economy is strong and people are feeling good, they're more likely to book those vacations, splurge on fancy hotels, maybe even treat themselves to an upgrade to first class.
Because YOLO, right?
Exactly. But when the economy starts to weaken and people are worried about their jobs or their finances, travel is one of the first things to get cut from the budget.
Makes sense. It's a lot easier to justify skipping that trip to Europe than it is to tell your landlord you can't make rent this month.
Exactly. So by looking at the earnings reports from airlines, hotels, and all those other travel-related companies,
Yeah.
we can get a pretty good read on consumer confidence.
Yeah.
Are people still feeling optimistic enough to spend money on those extras? Or are they starting to tighten their belts?
This is incredible. It really shows how interconnected everything is in the economy.
It really does. And speaking of interconnectedness,
Mm-hmm.
this whole conversation about earnings reports and consumer behavior, it reminds me of something else we were talking about earlier. Remember all those headlines a few weeks back about the super core CPI?
Oh, yeah. Those were everywhere. Everyone was freaking out about how the supercore CPI was at some crazy high number. But to be honest with you, I had no idea what that even meant. It sounded like a marketing gimmick to me.
It does sound a little made up, right? Like something out of a comic book. But it's actually a legitimate economic indicator. It's basically just another way of measuring inflation.
Yeah.
But it's even more niche than the regular core CPI.
Even more niche. Why even bother?
Because sometimes it can be useful to really drill down into data and get a clearer picture of what's driving inflation. So with the regular core CPI, you're already stripping out volatile things like food and energy prices. But with a supercore CPI, you're taking it a step further and removing even more things that tend to fluctuate a lot.
Like what?
Things like used cars, airfares,
Yeah.
stuff like that. So the idea is to try to get an even clearer picture of what's happening with inflation underneath all the noise.
Okay, I get it. But if it's so niche, why was everyone freaking out about it?
Well, in this case, the reason the supercore CPI was making headlines was because it had come in higher than expected, which led some people to believe that inflation was about to come roaring back.
Oh, so everyone jumped on the panic button without really understanding what they were looking at.
Pretty much. But here's the thing. That spike in the supercore CPI, it was mostly driven by just one factor, housing costs.
No.
And as we already discussed, housing can be incredibly volatile. It's influenced by a million different things, and it doesn't always reflect broader inflation trends.
So it was a false alarm.
Pretty much.
Yeah.
But you see how easy it is for this kind of information to get taken out of context and twisted around to create fear and uncertainty.
Totally. It's a good reminder that we really can't just blindly trust headlines or social media posts. We have to dig a little deeper and try to understand the whole picture.
Exactly. Don't just read the headline. Read the article. And even then, don't be afraid to question what you're reading. Look for those potential biases. Consider the source. And most importantly, think for yourself.
Love it. Okay, so as we wrap things up here, is there one key takeaway you want to leave our listeners with today?
You know, at the end of the day, understanding the economy isn't about memorizing a bunch of definitions or becoming an expert economist overnight. It's about cultivating a sense of curiosity. It's about asking questions, and it's about learning how to think critically about the information that's all around us.
I love that. So as we head into the coming weeks with all these earnings reports and CPI data releases, and who knows what other economic surprises are in store.
It sounds like we've got a lot more detective work to do.
We do. Let's stay curious, stay informed, and never be afraid to ask questions. Thanks for joining us for this deep dive into the economic data. And remember, keep asking those questions. Until next time.